everyone, good evening. You're watching The Money Show right here on ET Now. We just had a very comprehensive talk on what exactly is it that you should do with your portfolio at a time when the markets are cracking and fixed deposit rates as well are being cut by many banks. Now, all the unit holders of the Kotak Standard Multi-Cap Fund, listen in. We are catching up with Harsha Upadhyay, the fund manager, to talk about what exactly is it that his investment strategy is, what should current and prospective unit holders look out for. Karanya Rao joins us now to take forward this discussion. Karanya, first let's talk about what exactly is the multi-cap fund and how is it done so far?
Well, yes, before we get on to that interesting conversation with Harsha Upadhyay, let us get our viewers a glimpse of what exactly is Kotak Standard Multi-Cap Fund all about. Firstly, it has an AUM of about 26,000 crore rupees as on the end of May this year. If you look at the risk factor, it has about moderately high, risk incline at this point of time. So, it's not a very safe bet, at least according to our riskometer, but yeah, moderately high is something where we would like to look at it as. For next up is the kind of returns it has generated over periodic intervals. Firstly, over the last 7 years, it has generated 17% returns. Over the last 5 years, 14%, and in the last 1 year it has done a whopping 18.5% growth. So clearly it has generated immense value for all of its unit holders, no matter when they have entered in, 5 years, 7 year or the last 1 year. Let's talk about what is the exposure to the various sector that this particular fund has. The top sectoral allocation is, once again, like many other of these significant funds, these well-to-do funds, it is towards financial space. 38.1% is what the exposure is exactly. For energy, it has a 14% exposure. IT 7.5%, cement 7%, consumer goods 6.6%, construction 6.3%, auto 3.9%, cash 3.2%, others, a miscellaneous pack sort of sectors, everything else comes under 5% exposure bracket. What are the stocks that are featuring on top of the list? HDFC Bank, almost 7%. Next is RIL 6.7%, ICICI Bank 6.4%, Axis Bank with 5.6%, there's L&T 5.2%, Infosys almost 4%, TCS 3.5%, SBI 3%, Ultratech Cement 2.7%, and lastly there's RBL Bank. These are the top 10 names that are part of Kotak Standard Multi-Cap Fund. Let's touch base with the fund manager himself to understand the fund better, the objective of it better, and the various stocks that feature, the various sectors that feature, and the rationale related to it. Let's welcome in Harsha Upadhyay from Kotak. Hi Harsha, welcome on board. Firstly, what's the basic theme of the Standard Multi-Cap Fund scheme? What is the investment strategy behind it?
As the name suggests, Kotak Standard Multi-Cap is a multi-cap fund, which means that it can invest across market capitalization categories such as large, mid and small cap. There are no restrictions. The investment mandate is to have a blend of top-down and a bottom-up approach in terms of investments. For example, at any point of economic cycle, there will be few industry segments which are likely to do better than the rest of the market. The idea is to identify some of those sectors, and from those selected sectors, through bottom-up research, identify investment opportunities. So that's been the investment mandate. And generally, we look for companies which are scalable, which have very strong competitive advantages, and also the management quality and integrity and governance standards are assessed. And finally, we look at it from an absolute as well as relative valuation perspective, and then finally companies are chosen in the portfolio.
Harsha, as you mentioned, it's a multi-cap fund. It of course comprises of a lot of names from the broader end of the market as well. But in a world where we're looking at DHFLs, ILNFS, how do you weed out the bad from the good when it comes to selecting the names or selecting your exposure to a particular sector?
Investing is never easy. It's always challenging, whether it is today's time or in the past. We have always seen various challenges, but our focus is always to invest through our fundamentally driven research inputs. We do very rigorous research in terms of financial analysis. We also look for management integrity and very good governance standards, and we analyze whether that business is a sustainable, scalable one or not. And finally, we take a hard view in terms of where the valuations are. A combination of all these factors are always used in terms of our investment ideas. Whether it is a bullish phase, bearish phase, or a sideways market, we don't deviate from our investment mandate, and that's what gives us an edge in terms of selecting some of these good companies. And mind you, in investing, it's never 10 out of 10. It happens only in shooting or in archery. But in investing, even if you get your 6 or 7 companies out of 10 as good ideas, and that should be sufficient for the entire portfolio to do well. So our focus is to reduce mistakes and keep doing what we have been doing in the past and continue our investments.
Right, that makes sense. But let's talk about some of the sectors you have a high exposure to. Financial services, that makes up for a large chunk of your fund. Can you tell us what makes you so optimistic on the sector?
When you look at our portfolio today, financials obviously are one of the largest proportions in the fund, and also there is an active weight in terms of active bet that we have taken on financials. But if you look at it closely, you will find that we are out of some of the problem areas which are known to everyone. For example, we are underweight on PSU banking space, we are underweight on NBFC segment. So to that extent, while we are overweight on financials, we have kept away from some of the problem areas. And in rest of the financials, the business has been growing at reasonable pace, while there has been some slowdown overall in terms of the credit growth, but there is a large runway for growth, given that today most of the PSU banks or NBFCs are not in a position to lend. Some of the names that we have in portfolio will have a good runway for growth going forward. And also the yields which are coming down so sharply today also give more ammunition for some of these banks as they make more profits on their treasury investments to look for better growth without raising capital. And overall, we believe that in a scenario where overall earnings growth has been very subdued, this is one pocket where the earnings growth trajectory is going to be positive and also likely to be stronger than the rest of the market. And that's the reason why we have been overweight on financials at this point of time.
I must compliment you on the fact how smartly your fund has outperformed over the last 2-3 months, and this is a period full of unpredictability, uncertainty, and very heightened volatility. But the question that I'd like to ask you is whether you're confident of being able to sustain this outperformance.
Actually, equity investors should never be looking at 2-3 months for any investments. I think the focus has to be always a long-term one. If you look at our portfolio, while it has outperformed in the last 2-3 months, it has also outperformed since inception, which is almost about 10 years. Irrespective of which phase of the market that you are in, whether it's a bullish, bearish, or a neutral phase of the market, the fund has consistently delivered outperformance against benchmark. That's because we have stuck to our investment discipline. We have made right investments through our research-driven ideas, and overall we have been able to withstand whether it's an downside risk or the upside risk. We have been able to manage the portfolio well through diversification. So some of these will continue to happen over a period of time as well. So to that extent, I think whatever you have seen in the past will continue. Whether we'll be able to outperform or underperform, I don't think anybody can guarantee that.
Okay, that's heartening to know, Harsha. But before we let you go, just want to get in, a message for all of your unit holders or all the prospective unit holders. What would be your message to them, especially given a market environment like this?
I think clearly every equity investor should be looking at disciplined and staggered investments across market cycles to really withstand the volatility, and that's what should be practiced even in this fund. And also the focus should be longer term. Ideally, equity investors should be building their corpus for 5 years, 10 years, or even more than 10 years. So to that extent, one should not be focusing too much on the short-term volatility or short-term underperformance, but stick with portfolios which have coherent investment strategy and which manage risks well. I think if you do that and if you make regular investments, definitely there is wealth to be created over the long term.
Great, Harsha. It's very heartening to get in your perspective and your insights on the markets, and of course some deep dive analysis of your fund as well. Thank you so much for taking time out and joining us right here on ET Now and on The Money Show. With that, we'll slip into a short break, but do remember there's lots lined up for all of our viewers out there. Are you hit by the month-end cash crunch? Enjoy the weekend in your city and within your budget. Know what's happening in your city on the other side of TMS.